good morning to everybody. Welcome to our webinar today, which, as you can see from the title slide here, is all about dividends versus salaries, which is a really common question that we're asked by business owners and directors that we work with. So hopefully we'll be able to answer all of your questions today. A couple of housekeeping issues just to get things started. This webinar is being recorded, so we will make an on-demand version available on our website later on today, and we'll also email everybody who's registered to attend this webinar later on with the on-demand version. Hopefully, we've got time for some questions with the team at the end. So if you're familiar with Zoom, if you're not familiar with Zoom, go to your toolbar and you'll see there an option that says Q&A. If you click on that, that enables you to put your questions through to our speakers today, and providing we've got lots of time left at the end, we'll try and answer as many of those live as we possibly can. So let's get started. My first job is to introduce you to your presenters, and then I'll come back at the end when we're ready for questions. So Dan and Shanie, welcome to you, our presenters here at Havard and Associates today. At this point, I'm going to hand over to you and we'll come back for questions. So on you go.
Thanks, Joe. So today we're going to be looking at dividends versus salaries and which option is the best for you, depending on the business circumstances. Sometimes it needs to be looked at on a case-by-case basis. Sometimes you could have other forms of income or other personal circumstances, but there are actually advantages and disadvantages to both types of income.
So we'll be looking at today which is the most tax efficient way to take profits from your business. Obviously, you spent lots of time and effort building up your business, so we want to make the most of the money that you've earned. So let's have a look at what's the most tax efficient way to do that.
So the first thing we need to look at is how dividends are actually taxed in the UK. And there's various ways that they're taxed depending on the tax bands that are currently in place. So every taxpayer has a tax-free dividend allowance of £2,000, and any dividend income over this amount will be taxed at 7.5% for basic rate taxpayers, 32.5% for higher rate taxpayers, and 38.1% for additional rate taxpayers. And you can see the income band thresholds just at the side of each of the rates.
From April 2022, so as you're aware, we're just into a new tax year, so we're just past the 5th of April. So for the new tax year being 6th of April 2022 to the 5th of April 2023 and onwards, these rates are actually increasing. So the basic rate band, you will now pay 8.75% if you're a basic rate taxpayer, 33.75% if you're in the higher rate tax band, and if you're in the additional rate tax band, you will pay 39.35%. It's also worth noting that this is your overall income. So this is your total income, your salary, employment, self-employment, and dividend income, not solely your dividend income. So you as a whole, as a person, everything that you've earned in that tax year, we're looking at that total income figure. And that total income figure that you've earned will put you into a particular tax band, and that would then determine how much tax you pay on that dividend.
Exactly.
Dividends also are the last slice to be taxed. So your employment and self-employment income would be taken into account first, and those will be taxed obviously at the higher rates, and the dividends will be taxed last at the rates you can see on the screen.
Next, we'll be looking at how much salary should I pay myself. Usually, a lot of the time, people will pay themselves, say for instance, if they have a limited company, they pay themselves around £12,000 per annum, which is basically making use of the personal allowance that's available. Sometimes it might be a bit lower because people might not want to pay income tax and they want to just be within sort of the national insurance threshold.
We're going to have a look on the next slide as to the pros and cons, and really how much we should be paying ourselves, what the benefits are, and what the cons are. So really, depending on your personal circumstances and your company circumstances, we would look at that case by case and assess what's best for you. But generally, as Dan said, we would generally put people on around 12,000 salary a year. Although, you know, it is not ideal, people don't want to be paying tax for national insurance. Paying national insurance is actually a benefit to yourself, and we will see as to why that is on the next few slides.
Yeah, so finding the right combination of dividends. Sometimes you'd have to look at more of a higher dividend. Sometimes you need to look at a lower dividend. And as Shanie said before, it could be dependent on the tax bands that you're in. But as Shanie was saying, also to accumulate qualifying years for state pension, your salary must be above £6,240. If you earn more than £9,568, you'll have to pay NICs, which is what I was talking about earlier. Some people might want the sort of 12k per annum, but some people might want to just be at that sort of mid-range area where they would just have to pay national insurance. And obviously, by paying national insurance, you're paying a stamp. This helps you with your state pension benefits later down the years. And you will start to pay income tax on your salaried earnings above £12,570.
So next we're looking at what are the benefits to paying yourself a salary. And on the next slide, we will see there are actually a number of benefits to doing paying yourself a salary before we declare any dividends. So as we've mentioned already, accumulation of qualifying years towards your state pension. So by introducing a salary that enables you to pay a bit of national insurance, what you're actually doing is contributing to your qualifying years, which means once you reach state pension age, you will be entitled to your state pension. So we always do advise that you do that. We don't want you to get to state pension age and then realise you're actually not entitled to that. Also, by having a payroll scheme from your company and paying yourself a salary, you're actually then going to be entitled to maternity and paternity benefits. If your company doesn't have a payroll scheme, there would obviously be no way of you receiving your maternity and paternity pay. It often helps when we're applying for mortgages. Sometimes, you know, the figures are easier justified, just can help there when you're applying for mortgages and things like that. Also, for your company, if you are paying yourself a salary, so for example, if you are paying a salary of £12,000 per annum to yourself, this is a tax allowable expense for your company. So if you are paying a salary of 12,000, actually you're going to save corporation tax of £2,400, or there or thereabouts, being around 20% of your salary that you're taking from your company.
But be aware, drawing a salary requires both you and the company to pay national insurance contributions. Obviously, if you're paying the full £12,000, then you've got to understand that there'll be employer national insurances as well. And there could potentially be pension liabilities as well, depending on whether you need to opt into a work-based pension scheme. But from April 2022, both employee and employer NICs will increase by 1.25 percentage points. So that's something to be aware of if you actually have the, let's say, cash flow to be able to afford that.
In contrary to that though, so you may have heard of something called the employment allowance. So when you have a salary that's got national insurance contributions attached to that, employers are liable for paying national insurance on behalf of their employees. You may remember, or you may recall, the last few years this has increased year on year. So for this year, you have got an allowance of £5,000. And what this means is your employer contributions, you won't actually physically have to pay those until your liability exceeds £5,000. So you can run up a bill up to £5,000 of employers' national insurance contributions. Anything in excess of that, you would then pay over and above that amount. But if your contributions are £5,000 or less, you actually don't have to pay the employer's rates. It would only be the employee's rates that you would have to pay. But as an employer, that's not going to cost you any further money. That will be included in the salary. But employers will be squashed over and above under £5,000.
Now, there's certain eligibility criteria for the employment allowance. It can be used by businesses or charities with class 1 liabilities below £100,000 in the last tax year. And we think that that would probably be for the majority of our clients. It cannot be used by public bodies and businesses that carry out more than half their work for the public sector. Another thing to note is for certain dental practitioners that would receive more than 50% of their income from an NHS contract. This would actually prohibit you from applying for this employment allowance. So this would have to be something that we check maybe annually to determine what sort of rate of NHS income to private income that the practice actually generates. It cannot be used by companies only employing one person paid over the Class 1 secondary threshold and who is a director of the company. It cannot be used for people within the IR35 rules, so people that have been caught by HMRC with the new disguised employment rules. It cannot be used for personal or domestic staff unless they are care workers. And you can claim the employment allowance through the payroll software. That's it.
Thank you. I think at that point we are going to hand back over to Joe. Thank you for joining us today. And Joe, over to you. Thank you.
Yeah, thanks very much, Shanie and Dan. That was brilliant. I think you've explained that really well to everybody. What I would say is that there may be some individuals watching this that have issues that are very specific to them as an individual. So if you want to ask any of those questions outside of this webinar environment, then please just drop us an email directly through the website, and we'll be able to pick that up with you personally rather than sharing that on the open Q&A. At the moment, we don't have any questions waiting for you. There was something earlier that cropped up, and just thinking about business owners generally. Do you have to pay yourself a salary to be able to add benefits in kind through the business? So things like health insurance or a company car, is it important to pay yourself a salary to be able to do that, or is that irrelevant?
So yeah, so a salary for a company is actually different from benefits in kind. There's actually a multitude of benefits in kind that HMRC recognise. Like you mentioned, there could be health insurance, there could be a company car. So that would usually be something different. But yeah, there would be benefits to, for instance, maybe an electric car. A lot of the rates on electric cars, the Class 1A rates are actually quite low at the moment with the government's initiative to become more fuel efficient and things like that. So yeah, that would actually be something separate to a normal salary.
Okay.
And yeah, for instance, if a company decided to give a director a benefit in kind, the company would have to pay Class 1A national insurance. But in the same way that a salary would be tax efficient, so would the Class 1A national insurance, because you'd get that deducted from the company's profits. So yeah, there are benefits, but there are also disadvantages as well.
Okay. We do have a question here from Laura. Thanks, Laura. Could we explain the employment allowance maybe with an example? I don't know if that's feasible in this session. I can go back up to that slide if that's helpful.
Yeah, absolutely. If we could pull the slide up, we can try and explain that in a bit more detail.
Yeah.
So we actually do, if Laura is a client of ours where we actually operate the payroll for her, this is something that we would consider on a case-by-case basis, as we said. So generally, we can not apply the employment allowance if there is only one employee that's on their payroll scheme and they are the sole director, then that company would not be able to claim the employment allowance. If in this case, if there are a number of staff members, then there's no reason why they can't claim the employment allowance, other than one of the reasons listed above. What I would do is, Laura, I know we've got a number of clients with that name. Laura, if you could email me directly, I will have a look into this for you. But by way of an example, let's just assume we've got 2 members of staff for this company, and they both have a salary of 12,000 each. That would give us £24,000 salary. And I don't know off the top of my head what the national insurance contributions would be. I think they would be around about £400 per person for the year. So let's just say that the company owes around £800 of employers' national insurance for that year. Because that £800 falls under the £5,000 threshold, that actually would not be due. So what you would find is when we send you your monthly payroll letters and the workings, you would see the employer's national insurance contributions, let's say, for argument's sake, for previous years, it would have been £138 for those months. And then underneath there would be a line that says less employment allowance, £138, balance due, 0. It might not be 0 because obviously they would owe tax and employees' national insurance, but for the employment allowance, that would then be taken off and the payment would be reduced by that amount. But as I say, if Laura could email me directly, I can look personally at your case and identify any areas that you might need help with.
Lovely. Okay, hopefully that explains that well enough, Laura. But as I say, if you want to email directly, we'll be happy to take that. We do have another question here from Ian. Thanks, Ian. What he's asking, for straightforward, simple cases, is the most tax efficient way is to have a salary of 12k and then the rest in dividends. That's still the most tax efficient method.
Yeah.
Generally, yes. That is generally what we advise our clients. As we've mentioned, case by case, we do look individually at what is best for you, taking into account your other circumstances. So what other personal income do you have? Obviously, that would vary person by person. But generally, we do like to have around a £12,000 salary, as we say, to use up your personal tax allowance. And also, we want you to pay a little bit of national insurance contributions, just to keep your qualifying needs up to date, to ensure you're entitled to your state pension when you reach your state pension age. Yeah, and then we top that up with dividends at the end. So anything over and above your salary that you might wish to take, what we should usually do is work out what you need each month and do a monthly dividend to declare anything over and above you want to take from your salary. But yeah, as we say, we review case by case, but that is usually what we would recommend for our clients. And I'd add also that would be per person and per director. So if you've got a limited company where there's 2 directors, whether it be a husband and wife or friends, business partners, we would recommend that per person. So you're using up your personal allowance and your personal national insurance contributions.
Okay. And a question here from Chris, is there a difference between drawings and dividends?
Kind of, yeah. So drawings are basically undeclared dividends. So what will happen is usually you'll draw monies from the company. So say you was drawing £1,000 a month. That would actually go to something called a director's current account. And then at the year end, depending on the reserves of the company, we would actually convert that into dividends, which would then go on to your personal tax returns. So yeah, drawings are kind of like a first stage of a dividend that will be converted into a dividend later down the line. That could actually also, if the reserves weren't that high in the company, that may actually be turned into a loan as well. That's another area that could happen. So, yeah.
That's a whole different subject to director's loan account, isn't it? Maybe we'll come back to that in another webinar and explain that in detail. Okay. All right. Well, I think at this point we've taken as many questions as we can. As we mentioned earlier, if there's anything that's sort of pertaining to your own personal circumstances, we're happy to take those privately on email, and here's Dan and Shanie's email for you to get in touch. I just want to say thank you to you both for presenting today. I think that explained it really well. And again, to everybody that's attended today, thank you for joining us. The on-demand version will be available later this afternoon. And we look forward to our next webinar. We're going to be holding these monthly, and of course, you'll all be invited.
Thanks very much.
Thank you, Joe.
Thank you.